We're gonna call this one Roof Accounting for Dummies, because we're roofers, we're not accountants, but now we own businesses, so we need to learn our numbers. And ever since I started making video content, people have been reaching out, especially young guys that are new in business. And the common theme between all of them is that they don't know their numbers, they don't track their numbers, they don't even really look at it. And it doesn't surprise me because I was the same way, I was no different. It wasn't until I had been in business for probably like 2.5 years, and I realized, like, I feel like I'm doing all these roofs, I feel like I'm doing a lot of work, and I don't feel like I'm making that much money. So then that caused me to dive into QuickBooks and dive into all my little processes as far as bookkeeping to learn my numbers. And I feel like now in year 6, I've come a long way. So here we go. Profit and loss statement. Every business has a profit and loss statement. I'm gonna draw in a pie chart so it's easy to understand. And this will be specific to roofing, but construction, and then really just as a whole, every business has a P&L statement. The ratios just might look a little different. So first you have your sales. Everyone likes to talk about sales because we kind of talk about sales and like, how big is your business? How much do you do in a year? Are you a $1 million business? Are you a $10 million? Are you a $30 million business? That's sales. So that's going to account for 100% of your profit and loss statement. So this giant circle is 100%, and that's your sales number. So if you do 10 million a year in sales, this circle represents 100% of your sales, $10 million. In roofing, we have costs of goods sold, we call it. So I'm gonna write that here so it's easy to understand. Cost of goods sold, or COGS, is the acronym for it. So this category is going to represent any expenses that you incur as an effort to complete one individual job. So this is going to be your material, your labor, dumpster, permits, sales commission, any expense that you incur as a result of taking care of that one individual project for that one individual customer. On average, we can say maybe this is 70% of your sales number. So you started out with $10 million in sales, but $7 million went to taking care of those individual jobs, and then you're left with 30%. And this we call gross profit. But unfortunately, we don't get to keep this 30% what's left, gross profit. That's not all our money, because we have overhead. So overhead is going to take more out of your gross profit and leave you with less. So we'll call this one overhead. Overhead is going to be any expenses your business has, whether you do any jobs that month or not. So you could not do a single job next month and you would still have to pay your overhead expenses. So this is going to be things like rent, insurance, payroll, and payroll for non-roofing employees. So office, supervisors, things like that. Marketing. You've got all sorts of things in this category. All your office supplies, dues and subscriptions, any like online services you use, any expenses that have nothing to do with taking care of an individual roofing project is going to put you in here. So let's just say your overhead's 15%. So now we started out with 100% of your sales number. Then to take care of your individual jobs, we lost 70% of that number, which left us with 30% gross profit. Then our overhead, which was another 15%, leaves us with 15% of net profit. And obviously, we're in business. We want to make as much money as possible. And it's very simple on how to do this. There's not that many ways to make more money in your business. we can lower our cost of goods sold. We can lower our overhead. And we can increase sales. But we have to make sure when we're increasing sales, we're keeping our percentages, our ratios the same while sales increase, so that now 15% of a higher sales number is more money in your pocket. One of the best ways to make more money in your business, more profit, is to lower your cost of goods sold. So I'll show you what happens. Right now our cost of goods sold is 70%. And then after overhead, we're left with 15% net profit. But let's just say we were to be able to lower our cost of goods sold by 5%. That extra 5%, changing this to 65, would change this to 20%, and now all of this would be net profit. So if we're able to lower our cost of goods sold, we keep more money at the end of the year. How do you do that? There's a few ways you can do that. First would be material costs. So in my business, the material cost category of cost of goods sold is by far the largest category. And some ways we're able to save on our material cost is, one, pay suppliers early. So most suppliers will give you a discount if you pay your invoices early. Obviously, it takes some financial responsibility to be able to do this and manage cash flow. But if you're able to do this, we save 2%. So there's 2% savings on paying our invoices early. Another thing you can do is buy in bulk. So you can order bulk deliveries to your warehouse and store them, and this will save you big money. Obviously, you can't deliver and order in bulk every color of shingles, every color of metal roofing. So you're not going to be able to do this with every item that you buy. But underlayments, for example, accessories, for example. So with our underlayments, we actually save 21%. By buying a truck at a time. So that's 32 pallets of our underlayment. We're able to save 21%. Now, obviously, I'm not going to save 21% on my total cost of goods sold by doing this, but it adds up. So between paying early and buying what we can in bulk, we're able to save a lot of money and bring our material costs down. You can shop for different products that are maybe cheaper. Maybe you're overpaying for a certain manufacturer, and there's another manufacturer over here that makes a similar product, similar quality, and it's just cheaper. A lot of times newer products will come out and be cheaper, where the old established products are a little more expensive. So if you're able to catch a newer product, a lot of times they get released at a cheaper price, and eventually the price will climb up and kind of match where everybody else is at, but the newer products are usually cheaper. You can negotiate with vendors. So maybe you can shop around the different suppliers, get quotes for things that you already buy with your current supplier. Maybe you have a good relationship with your current supplier, so just show them. Be like, hey, these guys over here are offering me this for this price. Like, can you match it? And a lot of times they will, as long as you're not a pain in the ass about it. So that's how you can save on your material cost, which again is, in my business, the largest cost of goods sold category. Labor. I put no action here. I've never been willing to pay the guys less for the work that they do because roofing's hard, and I want guys that are with me long term. So I've never been willing to cut my labor costs in an effort to make more money. The one thing I will say is if you're using all guys in your payroll, maybe if you look at using subcontractors, you'll be able to save a little money on your payroll expenses, workers' comp, things like that. But I've never been willing to lower my labor costs to try to make more money. 3, this is a big one, and I know a lot of roofers struggle with this. I have it as fixed estimating. If you're a roofer and you charge per square, so I have per square versus line item, I don't think you should do that. I don't charge per square. I actually get mad at people when they ask me how much I charge for a certain roof per square, because every roof's different. A lot of roofs have different details to them. No roof is the same. So charging this big blanket number per square for a certain roof, to me, is silly, especially with today's technology. So we have in our CRM smart estimate templates where all somebody has to do is pull out the Eagle View, enter the Eagle View data into a system, choose what roof we're quoting, answer a couple questions, and it spits out a line item estimate for that job. How much nails are we going to need? How much underlayment? How many shingles? What's the labor cost? What's the permit cost? What's the dumpster cost? And then we're adding a profit margin to our cost. And it's to the penny. So that's how we estimate. And I feel like if a lot of roofers switch to estimating that way, they would realize that they're not charging enough money. Because I see competitor quotes all the time, and I don't understand how people are running businesses charging what they're charging. Customer P&L reports. So at the end of every job, you should be going in QuickBooks and running a P&L report for that individual job to figure out if your estimating systems are working. Because you may estimate a job to make 35% gross profit, but then if you go back and look at the job's P&L report, you may find that you made 22% gross profit. Well, that's a problem. So then you have to, after reviewing the customer P&Ls, if there's errors, you have to go back to your estimating systems and find out where are the errors, what's priced wrong, what are we missing, and correct those errors. And after doing that long enough, your estimating systems will be dialed in to where if you say you're going to make 30% on the job, you're going to make 30% on the job. Or maybe you're even going to make more than you thought you were going to make because you built little cushions into your estimating. After doing this, you're probably going to notice that you need to raise your prices because most roofers don't charge enough money for their services, and that's why most roofers have a hard time paying. A lot of roofers are ripping off sales guys. A lot of roofers aren't paying crews. A lot of roofers don't have extra money to invest in their business on things like marketing, equipment, office employees to actually grow the business because they're not making enough money per job. So if you dial all this stuff in, you're probably going to find you need to raise your prices. A problem you might run into when you raise your prices is you need to justify it. You can't be the most expensive quote if you don't have a professional image, a great reputation, great communication, a great service. You can't justify the higher number, so you're not going to get any jobs once you raise your prices, and now you're going to be out of work. So if you are going to raise your prices, you need to be able to justify it. Even if you can justify it, you're still probably going to see a drop in your closing percentage, which you may be able to handle, you may not. But that's probably going to happen. Even if you are, your image is the best, your reputation is the best, customers love you, you got great referrals, great reviews, you're still probably going to see a drop in closing percentage because some people are very concerned with the price of their roof. But that's okay. Because if your closing percentage works with keeping the schedule full and works in your business, then it's okay if your closing percentage isn't the best in your area. That doesn't matter. Some other things you might run into is how's your marketing? Do you have enough leads to be able to throw some of those leads to the side because you're not going to get the low-cost roofs, which may increase your marketing spend, which then goes into a little bit of a raised overhead to lower cost of goods sold. So it's like a game you play. We're always playing with the ratios, overhead, net profit, gross profit. Another way you can make more money in your business is by lowering your overhead expenses. In this example, our overhead percentage was 15%. What if we're able to shave, let's just say 2%? And I know 2% doesn't sound like a lot, but it actually is a lot. 2% is a big deal. Making 15% net profit versus 17% net profit is a big deal. It's a lot of money at the end of the year. So if we're able to shave 2% off of our overhead, we're going to steal it. And now that 2% comes to net profit. And now you have more money. So how do you decrease your overhead expenses? The two biggest categories in my overhead expenses are payroll and marketing. Similar to the cost of goods sold example, I don't like trying to cut costs on payroll. I track my payroll percentage at all times so that I know where it's at and I know if it's decreasing or increasing. The way your payroll expense decreases is just by increasing top line sales with the same number of employees. And now the sales number's higher, your payroll expense is the same, so the percentage of your payroll expense actually goes down. So if you track your payroll expense while you're growing in sales, you'll start to see it drop, and then you know that, I can maintain up here, so I have room to hire more employees. So let's hire more employees and grow the business. So I don't really try to cut costs in payroll, although I track my payroll expense constantly. Marketing. Marketing is a huge overhead expense. In my business, we're always in between 3 and 4% of our sales numbers. So, we did over $10 million last year, so that means I spent about $400,000 in marketing last year. So if 3 or 4% is my marketing category, how can I save on marketing? I've always wanted to grow my business aggressively, and we have been able to do that. So I'm not necessarily going to look to cut my marketing expense. I'm comfortable in between the 3 and 4% range, but I am going to make sure that my marketing expense is working, to make sure my marketing is working, to make sure every dollar I spend on marketing is getting put to good use and not being thrown in the trash. So don't throw your marketing dollars in the trash. You have to track everything. You have to track how much you're spending on a whole, and then you have to track what you're spending on the individual marketing efforts to find out if it's useful, or maybe you can take that money from this marketing channel and move it over here to something that's working a little better. ROAS, this is return on ad spend. So this is where we track every single dollar of money that's put towards marketing, and we divide our sales number by our marketing spend to figure out how much sales do we get from every $1 of marketing spend. And then once you know I spend $1 to get $40 in sales, well, how much profit do I make off that $40 in sales? So if your gross profit is 30%, you take 30% of 40, and now you know that's what you make profit for every $1 you spend on advertising. Customer acquisition versus average gross profit. So for this calculation, you need to know how much does it cost to acquire one customer, and all this is your total marketing spend divided by the number of customers you acquired in that period, and now you know what it costs to obtain one customer, customer acquisition costs. Then you need to know your average ticket, how much is the average job you sell, and then you need to know your gross profit percentage. So say it's 30% gross profit, you would take your average ticket, whatever that is, take 30% of it, and now you have your average gross profit. If your average gross profit number is way higher than your customer acquisition cost, you're in good shape. It means you're spending a little bit to acquire a customer and you're making a lot off of that customer. You're in good shape. Closing percentage. The closing percentage is important because if you track the number of leads you get in a month, say, and then you take your closing percentage of that of the leads in that month, now you know how many leads you need in a month to fill the schedule for that month. So knowing your closing percentage will let you know if you need more leads or you have enough leads and you're comfortable. Long-term versus leads today. So this is a big one. I invest a lot in long-term marketing efforts. So these are marketing efforts that aren't necessarily going to bring me leads tomorrow, but they're going to help me grow my business long-term. But because they're not bringing me leads tomorrow, they're going to make my customer acquisition cost higher. They're going to make my return on ad spend higher. Because I'm not bringing jobs and contracts and leads into the office today, but I'm spending money on long-term eyeballs, people seeing my business, people knowing who we are, people remembering me. So because they're not bringing me results today, they're going to make my marketing metrics higher. And I'm okay with that because in the long term, they'll bring these numbers down. Because now more people in my area know who I am. Not everybody in my area needs a roof right now, but because more people know who I am, down the road, it'll take less marketing dollars to reach those people because they already know me. So I understand that my long-term marketing efforts are going to actually make my short-term marketing metrics tracking look worse, but I'm okay with that because I trust that more people in my market knowing who I am on a long-term basis will grow the business long-term. So we've got a couple other categories. Payroll and marketing are the biggest ones. In my business, payroll is around 5%. It obviously always fluctuates, and marketing is around 3 to 4. And if my overhead's 15, obviously that makes up the bulk of the overhead. But there's all sorts of other categories. You've got gas, you've got dues and subscriptions, utilities, rent, computer and internet. A lot of those expenses are what they are. So I just have be mindful. Be mindful. Make sure you're not signed up for things that you don't use. Make sure you're not overpaying for shit. Shop your insurance every once in a while. But a lot of these expenses kind of are what they are. And you're not going to move the needle much by like trying to nickel and dime on every little expense. But you should be mindful to make sure you're not wasting money. The number one way to lower your overhead is increase sales. Because if you can increase the top line sales at your same overhead cost, well, the sales number being higher at the same amount of expenses is going to bring your expense percentage lower, and you're going to keep more money. If the whole circle gets bigger because you have more sales, but your cost of goods sold stays at 65% and your overhead stays at 13%, well, then that's going to leave you more in net profit because the number you're taking those percentages from is bigger. So growing your sales without increasing expenses is a great way to make more money. And I would say it's the best way if you're trying to grow a business, because you don't really want to be cutting marketing and cutting payroll too much, because you're probably always trying to hire employees. You're probably trying to give employees raises. You're probably trying to spend more and more on marketing so more people get to know your business, more people see you. So I don't really try to cut these per se. I just try to make sure that they're effective and that my percent ratios are growing in a linear fashion with sales. And inevitably, there's always times in my business where the sales number is growing and I haven't hired more people, I haven't spent more on marketing, and I'm netting more money in that period. But then I see the gap and I see that I have room to make moves here with hiring and make moves here with increasing marketing spend, and it just works. So I try to increase sales ahead of my overhead percentage growing. Okay, in conclusion, here is a real profit and loss statement like it'll show up in QuickBooks. Obviously not real, it's very simple for me to just write it on the paper, but this is essentially what it looks like. I showed you the pie chart, but when you're reviewing it in QuickBooks and you're actually looking at it on a daily basis, this is what it's going to look like. So when you hear people say top line sales, they call it top line because it's the top line of your P&L report. So that is 100% of sales, right? And then the first thing we take out of sales, the next category down, is cost of goods sold, or COGS. People call it COGS. As we explained earlier, this is everything it takes to complete a job: your material, your labor, your waste removal, your permits, your sales commission. And then you have the total of that category, 70%. So 70% comes out of your top line sales, which leaves you with your gross profit number. Now you have 30% left in your business. But we're not done yet. Out of that 30%, now you have your overhead expenses that get taken out. These are all the expenses that have nothing to do with taking care of a roofing job. These are expenses that you have to pay no matter what. Whether you did 2 jobs that month or 40 jobs that month, you still have to pay this expense no matter what. So your rent, your insurance, your payroll, your marketing, etc. Total overhead expense is 15%. So now that comes out of what you were left off the jobs to 30%, leaving you with 15% net profit in your pocket at the end of the year. Now, so it's simple. It's very simple to make money in business. You either have to lower your total cost of goods sold, which will leave you with more gross profit, and then your overhead will be taken off of the increased gross profit to leave you with increased net profit. So we can lower our cost of goods sold, we can lower our overhead expense. So if we lower the amount of expenses coming out of our gross profit, well, obviously the gross profit number will be bigger, leaving you with more net profit again. And the last way is to increase sales. Increase sales while maintaining your cost of goods sold percentage and your overhead percentage. Because if these percentages stay the same while the income number raises, well, the number's bigger, and again, you're going to have more net profit. So in closing, it's very simple to make more money in business, but it's not necessarily easy. You know, if you want to decrease your cost of goods sold percentage by raising your prices, well, now you're going to run into all sorts of other issues through raising your prices. You're gonna have to be able to justify it to customers so that you still close jobs. You're gonna have to make sure that you look more professional than other roofers. You're gonna have to make sure that your Google reviews are on point. You're a 5-star contractor. You're gonna have to make sure your communication's good, your speed is good, the quality of your guys is good, clean job sites is good. You have to be able to justify raising your prices. Because if you can't justify raising your prices, you're not gonna be able to fill your schedule at higher prices. But you should raise your prices because most contractors aren't charging enough and they can't pay their suppliers. They rip off crews, they rip off sales guys. They have no money to reinvest in their business. So you probably need to raise your prices. Decreasing overhead expense, very simple. Decrease your overhead. But a lot of these expenses are what they are. You know, we can shop for different marketing expense because you need to market your business. You need people to see you. If you're trying to grow, you need more people to see you next month than saw you this month. So you're not really going to do that in cutting your marketing expense. One thing I will say is we spend a lot of money on marketing, but still, even though we spend all that money on marketing, referrals are still our #1 lead source. I hear a lot of guys say they should rely on only word of mouth. Word of mouth's the best. Word of mouth is the best, but it's not enough if you're really trying to grow your business. And I'm saying that as a guy who most of my leads come from word of mouth, even though I spend all this money on marketing, because there's still tons and tons and tons of leads that come from my marketing. Every lead in my business doesn't come from referrals. It is the largest category, but it wouldn't be enough to only rely on word of mouth. So because it's hard to really decrease your overhead in any meaningful sense if you're trying to grow the business, the only way to decrease your overhead percentage is to increase sales, is to sell more jobs. So it's very simple to make more money and to increase your net profit, but actually making it happen takes a while. And you have to actually be tracking all this stuff, and you have to have clean books, and you have to look at it daily. And if your books aren't clean, if you don't have QuickBooks, if you don't know how to use QuickBooks, it can be a mess. So you either need to learn how to do it yourself or you need to hire a professional bookkeeper. But I wouldn't say that the books are something that you would just want to give to a bookkeeper and never touch it, because you, the business owner, should be looking and knowing your numbers, because nobody cares like you do. Also, there's stories of bookkeepers stealing from people, and if you're one of those business owners that just gives your bookkeeping away and never looks at it, well, how are you going to know if someone's stealing from you or not? So that's about it. We're all business owners. We all want to make more money. We all want to increase our bottom line, and these are the simple roadmap to do it. And I realize that a lot of construction business owners aren't good with their numbers and aren't good with QuickBooks. So I'm going to start coming out with a series of videos that is like dialed in to QuickBooks specifically, so that you know what it should look like, and that so you're able to open QuickBooks and click any customer name and know to the penny how much you made on that job. Because that's kind of where it all starts. But tracking your numbers is super important, and not a lot of contractors do it, and that's why not a lot of contractors are able to invest in their business, pay on time, grow their business, and they're robbing Peter to pay Paul because they're not looking at their numbers the way they should be. So follow this channel if you want to know more. I'm going to come out with videos like this all the time now. The more young guys I talk to, the more I see that people need help and people need education, just like I needed education, and I learned most of my shit off of YouTube too.